Guy walks into a bar with $500,000 in his 401k. Second guy walks in, also has $500,000 in his 401k. They're both 50 years old. They both want to retire at 60. 10 years later, first guy is living off $40,000 a year, worried about running out of money. Second guy is pulling 70 grand annually and sleeping like a baby. Same starting point. Wildly different endings. Here's the uncomfortable question nobody asks. Which version of rich are you? I spent the last decade running a business surrounded by tax attorneys and wealth managers who bill $800 an hour. And I can tell you the dirty secret, they don't advertise. The number on your brokerage statement is basically fiction. What you actually own, what you can actually spend, what will actually compound for you over the next 20 years, that's a completely different number. And for a specific type of person, someone who understands what I'm about to explain, that real number might be 3, 4, even 5 times higher than what their anxious brain thinks they have. So here's what we're doing. I'm going to walk you through the wealth multiplier framework, how the same pile of cash gets transformed by 5 variables most people ignore, and why your buddy from college who brags about his net worth might actually be poorer than you. By the way, I built a free early retirement calculator because most online ones use garbage math. Mine uses the same Monte Carlo logic that BlackRock and Vanguard run internally, and it'll expose the actual weak points in your plan. I only ask for your email to send you the report. I don't store your financial data. Links in the description, okay? Central concept. Think of your wealth like a raw gold nugget. The gold itself has value, sure, but what you can actually do with it, what it's worth in the real world, depends entirely on how you refine it. You can smelt it wrong and lose 30% to impurities. You can store it in the wrong vault and watch inflation eat it. Or you can refine it properly, store it correctly, and suddenly that same ounce is worth double to you personally compared to the guy who did it wrong. Your wealth has 5 refining stages, and every stage is a multiplier. Let's start with the obvious one that somehow nobody talks about honestly. Account type. There are 3 piles your money can sit in. Tax me now, tax me later, and tax me never. A taxable brokerage account? That's tax me now. You get a 1099 every year for your dividends and capital gains. Traditional 401k or IRA? Tax me later. You get the deduction today. You pay ordinary income tax when you pull it out in retirement. Roth IRA, Roth 401k, tax me never. You pay tax on the seed, not the harvest. Here's the thing. $100,000 in a Roth is not the same as $100,000 in a traditional IRA. It's just not. When you're 70 and pulling money out, that Roth 100 grand is actually worth 100 grand to you. But that traditional IRA, if you're in the 22% federal bracket and let's say 4% state, that's suddenly $74,000 of actual spending power. Same statement, balance. $26,000 difference in reality. So a guy with $400,000 in a Roth is effectively richer than a guy with $500,000 in a traditional IRA, even though the second guy's statement shows more. The refining process matters. This alone is worth about 1.3 to 1.5x in hidden wealth if you structured things right. But now you're thinking, okay, tax treatment, got it. That's just basic optimization. Here's where it gets weirder. The second multiplier is asset allocation combined with something nobody wants to admit, your own psychology. Let me tell you about 2 guys I know. Both had $750,000 in their portfolios in late 2007, right before the world fell apart. Guy A was 70% stocks, 30% bonds. Pretty aggressive for someone in their 50s, but he understood long-term returns. Guy B was 30% stocks, 70% bonds. Super conservative, scared of volatility. Fast forward to 2026. Guy A, assuming he just held index funds and rebalanced, that portfolio is worth around 2.1 million. Guy B, about 1.3 million. Same starting point, $800,000 difference. That's not a rounding error. That's a different life. But here's the kicker, and I mean this. This is the part that keeps me up at night. Asset allocation is fake if you don't have the stomach to stay in it. Guy A's portfolio dropped to maybe 400,000 in late 2008, early 2009. Watching half your money evaporate in 6 months is psychologically indistinguishable from dying. If Guy A panicked and sold, moved to cash, waited for things to calm down, he'd have locked in those losses. His aggressive allocation would have destroyed him. The wealth multiplier here isn't just the allocation. It's allocation times the ability to stay the course. That's behavioral finance in one sentence. Your returns aren't what the market gives you. They're what the market gives you minus the stupid decisions you make out of fear. And most people, listen, most people make catastrophically stupid decisions when they're scared. I saw this running my business during 2008. I had cash flow. I kept investing. Guys, I knew with more money than me, they froze. They sold. They thought they were being smart, being defensive. They were actually cementing their losses. The market doesn't care about your feelings. Your portfolio is a machine. If you start manually overriding the machine every time you're nervous, you break the machine. So if you're the type of person who can set an allocation, automate your rebalancing, and then not look at your account for 5 years, you're probably 2x richer in real terms than the person with the same balance who checks their app every morning and makes tweaks. Third multiplier, and this one's technical, but it might be the most important. Sequence of return risk and forced selling, okay? There's this concept called dollar cost averaging. You invest a little bit every month. When the market's up, you buy less shares. When it's down, you buy more shares. Over time, you smooth out your cost basis. This is good. Everyone knows this. What most people don't know is that dollar cost averaging has an evil twin, and its name is sequence of return risk. When you're accumulating wealth, you want the market to go down. You're buying shares on sale. But when you're pulling money out, when you're in retirement or living off your portfolio, you desperately want the opposite. You need the market to not collapse right when your balance is at its highest. Imagine you retire in January of 2008 with $1.2 million. You need $50,000 a year to live. The market drops 40% over the next 18 months. Now your portfolio's worth $720,000 and you've had to pull out another $75,000 to cover living expenses while it was dropping. You're down to $645,000. For that same portfolio to get back to 1.2 million, it needs to go up 86%, not 40% to reverse the loss. 86%, because you were selling shares at depressed prices to fund your life. This is why 1 out of 4 Americans who retired in 2008 ran out of money or had to go back to work. They got sequenced. The timing destroyed them. So how do you protect against this? This is where the wealthy people I've worked with do something that sounds boring, but is absolutely brilliant. They don't think of their bond allocation as a percentage of their portfolio. They think of it as years of living expenses they can pull from without touching stocks. Let me make this concrete. You've got $1 million, you need $50,000 a year. Instead of thinking, I'm 60% stocks, 40% bonds, you think, I have $400,000 in bonds, which is 8 years of expenses I can pull from if stocks crater. 8 years. That's enough time for almost any market crash in history to recover. You don't have to sell your stocks at the bottom. You just live off your bond ladder, wait for the market to come back, and then replenish the bonds. The people who structure their portfolios this way are psychologically and mathematically 3x richer than the people who don't, because they've eliminated forced selling. They've removed the knife from their own back. Now here's a quick sidebar. In 2009, I watched a guy I knew, successful dentist, had about $2 million in his portfolio, very aggressive allocation because he was a long-term investor. Market dropped, he needed cash for his practice and for living expenses, he had no bond buffer, and his banker got nervous about his business line of credit at the exact same time. He became a forced seller in the worst possible moment. He sold $400,000 in stocks when they were down 50%. That's $200,000 of permanent loss he'll never get back. His retirement got pushed back 7 years. This is why real estate attorneys also specialize in bankruptcy. When the tide goes out, the people swimming naked don't just get embarrassed, they drown. Fourth multiplier. And this is the one that separates the people who build generational wealth from the people who just have a decent 401. Flexibility. Rigidity kills portfolios. The people who survive and thrive are the ones who can adapt. Let me paint you two scenarios. Market drops 25%. You're retired. You were planning to spend $60,000 this year. Person A says, well, I budgeted 60. I'm taking 60. This is my plan. Person B says, you know what? Market's down. I'm going to cut back to 52 for a year or two, skip the big vacation, keep more powder dry. That $8,000 difference in one bad year can be worth an extra $300,000 over a 30-year retirement because of how sequence risk compounds. Flexibility also shows up in when you claim Social Security. Whether you're willing to do part-time work for a few years if markets are rough early in retirement, if you can downsize your house, if you can move to a lower cost of living area. The people who think this is my plan and reality needs to conform to it are the ones who get wrecked. The people who think here's my plan, but I can adapt if the world changes, are anti-fragile. Here's a real case study. Two buddies of mine, both 52, both had about $500,000 saved up in 2020. Both wanted to retire at 60. Guy 1 had it all in a traditional 401k 75% bonds because he was conservative, no flexibility, planned to take Social Security right at 62, and lived in a high-cost area. Guy 2 had $300,000 in a Roth, $200,000 in traditional 65% stocks, and he'd already thought through his backup plan. If markets were bad early in retirement, he'd consult part-time for 2 years. Run the math forward. Guy 1 is going to have to live on about $38,000 a year after taxes when he pulls from that traditional IRA. And because he's so bond heavy, his portfolio's barely keeping up with inflation. He's stressed, he's checking rates constantly. He might have to go back to work full-time in his late 60s. Guy 2, even if markets are mediocre, his Roth means no tax drag, his higher stock allocation gives him better growth, and his willingness to work part-time for 2 years early on completely eliminates sequence risk. He's going to pull $55,000 to $60,000 a year, inflation adjusted, and he'll probably leave money to his kids. Same starting balance, two completely different lives. The multiplier effect is real. It's not linear. It's exponential. Now let me hit you with the uncomfortable truth. Most people will never get this right on their own. Not because they're dumb, because their brain is wired wrong for this specific game. You're wired to panic when numbers go down. You're wired to overcomplicate things. You're wired to obsess over details that don't matter and ignore the structures that do. I've worked with tax attorneys who bill $1,000 an hour. They don't manage their own portfolios. They're too emotionally involved. The smartest financial move is often having someone who isn't you making the calls when things get scary, because you will make emotional decisions, and emotional decisions in finance are almost always wrong. Lazy investing built more fortune than crypto memes. The people who got rich are the ones who set up the right structure, automated it, and then went and lived their lives. The people who stayed poor are the ones who kept trying to optimize, kept reacting to news, kept thinking they could outsmart the system. So here's your 3 takeaways, and I want you to actually do these, not just nod along. 1, figure out what your money is actually worth after taxes. If it's all in traditional accounts, multiply your statement by 0.7 or 0.75, depending on your bracket. That's your real number. If you don't like what you see, start contributing to Roth accounts now. Front load the pain. 2, calculate your bond allocation not as a percentage, but as years of living expenses. If you're 10 years from retirement or already retired and you don't have at least 3 to 5 years of expenses in bonds or cash equivalents, you are walking a tightrope without a net. Fix it. 3, write down your backup plan for when things go wrong. Not if, when. Markets will drop 30% at some point in your lifetime, maybe multiple times. What's your move? Can you cut spending by 15% for 2 years? Can you pick up contract work? Can you delay Social Security? If you don't have an answer, you're not flexible. You're just hoping. Hope is not a strategy. The people who are 3x richer than they think aren't lucky. They structured their wealth to multiply itself through tax efficiency, behavior, time, and flexibility. Everyone else is just watching a number on a screen and praying it goes up. One of these approaches works, the other one doesn't.